Meet Jasmine. Jasmine is a college student attending State University. Like many college students, Jasmine has a lot of things she needs to buy: books, laundry baskets, food, and so on. And she can pay for those things with two types of money: debit or credit. Debit is money that comes from a personal bank account. Credit is money that is lent to you by your bank. For example, let's say Jasmine has been using a credit card. Each time Jasmine uses the card to buy something, say a $100 textbook, her bank is loaning her the money. While that sounds nice, be warned, the bank isn't giving Jasmine this money for free. They expect her to pay a certain amount of money each month, called interest, if she doesn't totally pay off her balance by the due date. As you can imagine, this can get very expensive very quickly, especially when factoring in the high annual interest rates, or APRS, that are charged by these companies. However, there is a solution to this rather scary problem. As long as Jasmine always pays off her balance in full by her monthly due date, she'll never pay a cent of interest. Jasmine is shocked and thrilled, but still isn't quite sold on credit cards. After all, with all their flaws, are they really worth using? The short answer: as long as you avoid running up a balance, definitely. So why is that? Well, free money for starters. Most credit cards offer their users rewards, like cashback or airline miles, each time they make a purchase. For example, let's say Jasmine's credit card comes with 2% cashback. That means if Jasmine spends $500 per month, then at the end of the month she'll automatically get $10 back, no questions asked. Then, if that wasn't good enough, responsibly using a credit card also allows Jasmine to build a great credit score. This is a calculated number between 300 and 850 that summarizes your credit history, covering everything from your payment history to the age of your accounts. While we'll teach you more about your credit score, including how to get and improve it. In our next video, Credit Scores and Reports 101, just for now, know that most credit cards actually require a credit score of at least 600, plus at least $15,000 in annual income and a reasonable debt payment to income ratio, generally below 36%. However, thankfully for Jasmine, who lacks both credit history and a full-time job, she shouldn't have a problem getting a student credit card. In fact, the online application will take all of 5 minutes. She'll just have to be a full-time student of at least 18 years of age, with either a small amount of income, like from a part-time job, or a credit-worthy cosigner. However, at this point we have to say, be careful. Taking on a cosigner is no small matter. The account is still in your name, so any credit mistakes are on you and your cosigner, plus your cosigner is even liable for any of your missed payments. If Jasmine isn't quite ready for that level of responsibility, she can instead be added as an authorized user to her family's account. Not only will this allow her to get her own credit card, but in a few short months, the credit bureaus will treat her parents' credit score as her own. Sounds pretty great, right? Well, this strategy isn't a cure-all. Even though Jasmine isn't liable for payments on the account, her parents still are. Plus, many lenders will want to see you successfully handling credit on your own before giving you a major loan. Hopefully, you and Jasmine now understand the basics of credit cards. Be sure to watch our next video, which covers everything you need to know about credit scores, and be sure to check out our website, where Jasmine is a college student attending State University. Like many college students, Jasmine has seen a lot of her friends and family use credit, whether it's through a mortgage, a private student loan, or simply a credit card. However, Jasmine has always been too afraid to use credit herself, leaving her with no credit history and a non-existent credit score. What should Jasmine do? Well, beyond watching our 2 other introductory videos centered around credit, Credit Cards 101 and Loans 101, her next step is simple: understand her credit report and score. What is a credit report? A credit report is straightforward. It's essentially a detailed history of your credit, covering everything from your payment history to the age and status of your accounts, as recorded by the 3 major credit bureaus in the United States: TransUnion, Experian, Equifax. As you can imagine, this is quite a lot of information for anyone to process. So one company actually created a simple way to summarize this information called a FICO credit score. What is a FICO credit score? This is a calculated number between 300 and 850 that summarizes your credit report. The higher your score, the lower the interest rates, and the better the rewards you'll get from banks. A high credit score is also vital for several other things, like getting affordable insurance, finding an apartment, qualifying for a cell phone plan. How to get your credit score. Ironically, for such an important number, getting your credit score used to be quite difficult and expensive. Now, however, we recommend several websites that make it free and easy to get your credit score and report online. This is great for Jasmine, but she's still confused about one last thing. What exactly makes up a credit score? A credit score is actually made up of 5 parts, and from understanding each one, you can derive the 4 major ways to improve your credit score. Part 1. Payment history, 35% of your score. Because this is such a large percentage, it reveals the importance of paying every bill on time, even if it's just the minimum. If you're struggling with this, we highly recommend setting up automatic payments for everything, especially your credit card. Part 2. Credit utilization, 30% of your score. To avoid damaging this, we recommend not exceeding more than 30% of your maximum credit line, both total and for each individual account. If you're struggling with this, try paying off your balance early a few times a month or asking your bank for a credit line increase. Part 3. Length of credit history, 15% of your score. This component means, rather counterintuitively, that you shouldn't close out your old credit accounts unless you absolutely have to, as otherwise, you'll hurt your credit score. Part 4. Recent inquiries for credit, 10% of your score. This one's simple. Don't apply for new credit cards and loans unless necessary, as each credit inquiry will slightly lower your credit score for the next 12 months. Part 5. Types of credit used, 10% of your score. Unfortunately, we don't have a specific rule for this one, as we don't recommend applying for multiple types of credit just to boost your score. Final tips for Jasmine. Before we conclude, we just have 2 things for Jasmine to keep in mind. To build a credit history, and thus a credit score, you'll need to use credit. The easiest way to do this is to open a credit card, like a student or secured credit card, that is designed specifically for people with no credit history. Don't worry. We teach you everything you need to know in our 2 videos, Credit Cards 101 and How to Rebuild Your Credit. Be sure to check your actual credit report for mistakes at least once a year. Errors can dramatically affect your credit score. Should you find one, be sure to contact the credit bureau as soon as possible.